Hello everyone and welcome to this session. Today we are going to find out and analyze certain one of the very important topic, that is investing in stock market, good or bad. Okay, so we are going to make a deep dive and try to find out on this topic. So to begin with, let's have a standard disclaimer in place. So often we come across the discussion wherever, like in our friend circle, or maybe most of the family friends, everywhere, the whether we should do investing or not. This topic often comes to discussion wherever we move around. So let's try to analyze and find out whether we need to invest in a stock market or not. What are the pointers behind that? What is the risk management in place which should be, and what are the risks which need to be taken care, whether you, even if you are taking up that particular investing process. All those points we are going to look into it today. Okay, I hope all of you can see the screen, uh, the PPT. So investing in stock market, good or bad, the topic for the today. So in this we'll be covering a few pointers around. That is, the agenda for the today's discussion is going to be investing versus speculation. What do you mean by investing, and the speculation, what do you mean by speculation? Next is some myths which generally people have, that is versus the reality. Okay, that is one point which will be covered, and will be covering, and why people lose money. Okay, that is the next pointer. Why equity works long term. And one next pointer would be like one short video we are going to play, which will give us some holistic idea about the entire subject. And next is the India growth story, risks and how to manage them, and how to start, and simple rules and the summary. This is going to be our flow of our today's topic. So let's get on to, and let's try to analyze one by one. Okay. Now, the first point would be that investing versus speculation. Now, what do you mean by investing, and what do you mean by, what is the difference between the investing versus speculation? And let's try to identify that. In investing, generally what happens is, you're owning a business for years, okay, and focus on earnings and quality. So in investing, what generally happens is we invest on, like, you buy some shares or stocks of some company or a business, and try to hold it for a some longer period of time. Again, it is not that any stock you buy, you are going to buy a stock which is a quality stock, a quality business, you can say, which has a good earnings, and a long term mega trend which is available for that company, and a good sector also. So we are going to have a quality company and hold it for a good amount of years. That is basically an investing process. Now, what is speculation? Speculation, what happens is, generally it is, it is kind of, the majority of the play on speculation happens on the inside of price movement only. Okay, it is generally, you can say, intraday, futures, options, and all these things are done based on the derivatives of the equities. Okay, not directly equities. Again, the derivatives, it's all, speculation, assumption majorly, and you invest on the money, and then it will be generally of a short term nature. Okay, by nature it will be of a very short term most of the times. So this is the thing, and the difference between these two is, in investing you would require, the lot of research and understanding the company, the management, risk, different different factors involved, connected to the company, all that. In speculation we don't have anything kind of that kind of a thing. You generally one generally, like, in the sense, people generally work on to the kind of a tips or some newspaper informations, all these things. You will not have a fundamental study in place for any kind of a speculation most of the times. The key difference is, as we understand, is that one is the time horizon, second is the research depth, and of course the most important thing, as it mentions, the risk control. In speculation, what happens is, you don't generally, one doesn't look into a risk factor to the great extent. Okay, and just put whatever, buy some large quantity of shares. Sometimes, you might be lucky so to get sometimes, and equally what happens is, the downside risk is, you end up losing. some great sum also most of the times. So that is the major difference between investing and the speculation. Now the thought process is one thing, as the slide mentions that no business and company will be great overnight. Okay, that is one thing. In case you get onto the investing, you cannot expect something to happen overnight great. Okay, it takes time. The over a period of time things change. Okay, and things change in the sense any company for that matter, during a very short of span of time it cannot make wonders and magic. It takes, as it's an ongoing process most of the times, and you may have to wait as to get a result also. So that part we have tried to understood now what is the difference between investing and speculation. Now next move on to the pointer, that is myths and reality about the stock market. Okay, so now there are generally, when you speak to any people around, and maybe a family, friends, all those things, people say always these are the myths. You often come across this kind of a myths which we look into. That is myth number one. It is mentioned stock market is gambling. Okay, the people generally say smart market is a gambling, because no, most of this what happens is there is no process which is followed for the investing. Okay, and people want a quick money, want to quick money, and they get into a kind of trading, as I was just discussing now, and get into a kind of speculative trades, and then most of the times get into a kind of a trouble also. So the reality is business with the data. No, when if you hold a business, good business for a with a good fundamental data availability and good company, if you hold, definitely it is going to make a difference. The myth number two is only rich people can invest. The reality is, today most of the speak, this one, the only rich people can do investing, and it is not for a poor people. In reality, what happens is, SIP today. I mean, it's not only today. In some now from some time there is a option called as SIP now. Okay, we can invest in step by step. Maybe a smaller amount also can be invested in a longer period of time. And even in equities also. Okay, even in equities also you can plan SIP, some monthly fixed income out of, if for a salaried people, or some funds are expected to come, all these people, all this amount can be spread across and diverted to the equities, which by if one planned properly. And the point number, myth number three is tips work. And reality, a plan beats tips on the. So what happens is, myth number three is always tips work, we say. Maybe one or two tips might work, okay, sometimes. And third or fourth, as we proceed, the tip starts failing because it is not fundamentally based. You have not done any research on that, and you just put dump some money based on some tips. And it will definitely have a downside risk, and maybe once or twice you might be lucky, and third and fourth, as we proceed, we might not get the desired result. And myth number two, it is too late to start. Okay, often we speak about it's too late. I have already late. It's already gone run up so much. If one plans to invest in stock market, it is like I would say it's like any train or bus. One goes, other stock comes. Okay, other fundamental stocks comes. There is a ample amount of opportunities. Any point of time. Okay, any given point of time, there is a given point of time. There is a great amount of opportunities. Definitely, the thing is that the early starting investing is the very good thing, but it is never too late. Okay, and it's, as the slide says, when is the best time? It's the right now. The right time is now. So you can start small, and as you proceed, you can always improvise, update upon those things. So this is a myth and versus reality, and reality is something different from generally a myth. Uh, as far as investing or a stock market is concerned. Now let's try to understand why people lose money. Okay, uh, whenever we come across any situation, or when we're speaking to somebody, people say that I had invested and I lost money. Why people lose money? So some pointers which is given is chasing tips and FOMO, buying high, selling low. This is a very very important thing. We most of the times people, what they do is, okay, whenever they want to do some investment in a stock market, they try to follow some tips, either some tips from some friends or some known sources, or some WhatsApp messages, whatever it is. And other things, what happens is, they try to read some newspapers and try to get information from there also, and try to get into the investment. And there is no process which they follow, like how much to invest, which company to invest, or the what is the, is it a right time to enter into this company. No process is being followed, just like you read something and invest directly. That is one point. What happens is most of the times, you when there is, whenever you read the newspaper. And one more important point which I want to bring it out here is, as when we newspaper, as we see, most of us are getting you rely on newspapers also, some of us at least. So most of the times what happens is, by the time the news it comes in newspaper, okay, almost half of the rally or 75% of the rally is almost, it is done most many of the times. And we start investing without any process into a place, and we start heavily. Maybe first day, second day, third day it might go up. We think that okay, it is going up, and again we invest heavily on that, thinking that it will go still too much high. And then what happens after a particular time, now there is a profit booking starts and starts dropping down, and in a panic selling we sell it also. In a panic mode you try to sell that also. So there is no process which we follow in investing, for the purpose, okay, this is a methodology, let's take into this way. And we keep on doing that, and then end up losing money also. No plan or emergency fund, forced to sell during falls. Okay, as the stock starts falling after particular time of rise, immediately you get into a panic mode and start selling also. People get into a panic mode and start selling. And most of the times, sometimes they end up losing money also. Over concentration or a leverage, you dump all the money in one particular stock, or invest in all the money available in a one particular stock itself you invest, or maybe one sector you invest. So the over concentration of the particular over concentration of the particular profile happens there. And you take too much leverage also. One person, I mean, whoever takes a too much leverage, now nowadays banks come up with a lot of leverage options also. You invest so much, bank will give you so much, and you take that particular advantage and try to invest those things, use those things. And what happens is, when you invest huge on a particular stock or a sector, you will have a risk management in place. You will not have any risk management in place, and it will be able to, there will be a lot of downside which will have on that particular way, ignoring basics, quality, valuation and risks. So the risk management is not taken care, the basics of valuation and quality of the business is not looked into, just start investing, will be always will have a people end up losing money because of these are the factors, because of these factors. Now let's try to understand. We have already seen some of the points now, and let's try to identify why stock market can be a good. Okay, and the points which are mentioning here is the compounding. That is, the small amounts grow big over the years. The compounding is very important. The compounding works. The principle works very nicely when the certain amount of years of time frame it is given. We'll also look into, as we proceed, we'll also have a video we'll be having a look into. We played onto the thing where our DMart founder Damani ji will be explaining us about the importance of compounding and how things can be thought of, how what should be. Of course, this is one of the slightly earlier video, might be a slightly older video, but of course, I mean, definitely this even today's real time also this still matches. He speaks about the video where the LTCG which was not available. Maybe if you go back few more years, there was a long-term capital gains were not available. I mean, it was not charged actually. Uh, Still having that also in today's this scenario also, still it works out fine. You can have, let's have a video played once after in between in this after this slide. So compounding is a works well over the small amounts and grow big over years. Ownership in this India's growth, that's the business profits. When you when one invests in ownership of a good company, now shares is nothing but what we buy a part of the company, shares, we become a owner to the extent what the investment what we do. Okay, so when we do the investment to a small extent and we enter into any good company and we hold for a longer period of time, Now, one thing which we need to understand is, India today is a growing country, as all of us know. The most of the thing is that India growth story in GDP growth is happening, demographic and middle class consumption is in a boom side, and definitely India is going to make a difference. Okay, as we proceed, next 1 or 2 decades is going to be definitely for India, and that way what happens is, in India's growth story, holding some good quality companies can make a big difference as we proceed. And of course, dividend and capital gains are also a part of the game. And one thing in investing is that it is not like any other asset class. We have a different asset class. Might be there is a gold, real estate, let's say bonds, and different, okay, fixed income, some instruments depending on related to fixed income. All these things we have other than investing in stock market also. But one thing in stock market which is very advantages for us, it gives us a flexibility of a liquidity. We can always sell out. You need not hold and take a company promoters and wait for a years. In case you have to, there is some emergency, you can always sell out, and there's a flexibility of liquidity to the in terms of stock market. It's not like any other asset class. If you have a home or any other property, you cannot sell out and get into a liquid in 1 or 2 days. It might not be feasible. Okay, it will take at least few weeks or months to sell that property. In case, I'm just giving you an example, but in case you have to do that also, it will take at least a weeks and months to make that happen. But in stock market, it is not like that. It can be within a day's time, with a limited time frame, it can be done also. So that is one point which need to be noted on to. Now, India's growth story at night. Let's try to now have a video played before we speak about this particular slide. Hope all of you can see the screen. Let me play the video.
At 40, but you save double the amount every year. Look at the difference that happens when you approach retirement age. Look at the amount of difference. ये दो बहनें हैं, Karishma और Karina. They're actually sisters in real life. All right. So let's say Karishma is the hardworking one. She likes to save and invest her money early. So she starts saving when she's 18 years old. Karina is the fun one. She wants to have a good time, go out, party, buy clothes, travel. So she starts saving when she's 25 years old. Karishma stops saving when she's 25 years old. So she saves for a period of 8 years. Karina saves the rest of her life. Till 62, she saves every year. How much do they save? 50,000 rupees a year. 50,000 rupiya har saal karte hain. But what a difference it makes because Karishma started early. And then when she's 40 years old, she has 55 lakhs, 52.25 crores. When 60, she has 12.8 crores. Whereas Karina, who saved for 40 years, ends up with only half the amount. तो जल्दी शुरू करने का इतना advantage है. Compounding is so great an advantage when you start early. So the one lesson I'd like these young people here to take away from you is start investing early. Even small amounts invested early make a huge difference 10, 20, 30 years down the road. Let me put it in words that you will understand. Most of us will have a career of about 30 years. 30 years in the financial markets, 30 years as an architect, 30 years as a doctor. A professional career, 30 to 40 years come there. Let's say 30 years out there. Let's say you start off life when you're 25 and you save your first 10 lakhs. आपने 10 लाख सेव कर दिया है. कैसे भी मेहनत करके 10 लाख बचा दिया आपने. Now you're able to double your money every 3 years. All right? Every 3 years you're able to double your money. The index itself goes up 16%. Right? So to double your money, you need to do about 21, 22% a year. It's not that hard. If you double your money every 3 years, in a 30-year career, you will have 10 doubles in your life. 10 times your money, you will have 10 doubles in your life. So suppose you start with 10 lakh rupees, all right? 10 lakh rupees when you're 25. When you're 55, can any young person tell me, if you double your money every 3 years, what will that amount become? Yeah, you're a CA or someone, you know all that stuff. He's right, okay? He's right. It becomes 100 CR. How does it become 100 CR? Let's do the math. Because it's always fun. I know you know this, but it's still fun, okay? 10 lakhs after 3 years becomes, if you double your money, 20, right? 20 becomes 40 becomes, 80 becomes, now let's round it off, say becomes 3. 3, that's after 5 years, 15 years becomes 3, right? Now see what happens in the next 15 years. 6, 12, 50, 100. 100. Think about it. If you have 100 crores, that even in today's depreciated rupee, that's about 10, $15 million. That puts you in the richest 1% in the world. Forget in India. It'll make you the richest 1% in the world. All right. What have you done? You bought businesses that have doubled every 3 years. All right. Are these opportunities there? I think Madhu put up a chart. I mean, there must be 100.
There will be, this video gives us a very clear idea of about what should be our way of thought process. Okay, in a way of where Damaniji explains about the thing that in case of when you invest in a good quality stocks and hold it for a longer period of time, it has its own benefits and advantages. What he is trying to explain, and definitely this concept, this video is available in case anyone wants to have a watch this video. You can always go to YouTube and check on this. It is the money, you can put it as 10 lakhs to 100 crores by Damaniji. This can be, you can always have a look later on. It's a full content which is available in YouTube. It will give you a perspective to understand how a thought process should be. Now, coming to our PPT, so the thing is, naturally will be the India grows at night. It says, now what is you mean by India grows at night is, as Damanji explains in this video itself, the good businesses, all the good businesses which we invest, most of the times what happens is these businesses run round the clock. It is not that even though we are might be taking rest at home, we'll be sleeping, but the business what we have invested keeps on working and tries to give us the inputs or a compounding effect always. So it works on the round the clock. If you are investing in some good companies, they keep on working, and and it keeps in does a compounding activity for us. So definitely this particular thing is very, very important. And India's growth potentials, he is connecting with the equity markets. Okay, if India grows at night, then investor can sleep well and hold great by holding great companies, is what he is trying to explain. So let's move on to the thing. So India, as mentioned here, India economy and businesses keep growing over the time. Let's have a long-term investing mindset is very, very important. Here now let's try to identify as we speak on to India growth story. What are all the factors which is giving a positive push for this India growth story? Young population and rising incomes. The one of the very important thing, steady consumption of so many things. So naturally, these companies or businesses, what we are talking about, are going to be benefited directly or indirectly by lot of these factors what we are speaking now. Digital rails, that is UPI, GST, formalization, helping business to scale up, and global attention and domestic participation improving liquidity. Earlier, if you go back and look for long years back, we used to import a lot of things. From most of the items used to be imported from outside different countries. Nowadays, after large involvement by government, a concept of Make in India came some years ago, and there is a constant push by government by on these factors. The PLI schemes has been about, PLI stands for Production Linked Incentive Scheme, and there is a lot of tailwinds and push given by, tailwind is stand for what do you mean by tailwind is the push from the natural push from the natural push, we can say. Okay, which the companies gets benefited, and a lot of support given and the push given to these businesses to make come out with the better results, better production, better productivity, and all these factors. So and more of the more than import, export is given also some importance. As we were earlier importing, now the exporting making in India, utilizing the goods required for India in India itself, and also the exporting, which will definitely make a positive impact on our economy. So these are the factors which will definitely make a India growth story, and definitely next 1 or 2 decades is going to be for India, as the way in which we are steps are taken. Definitely 1 or 2 decades is going to be a very positive side for India. That is one point. And now let's try to analyze the risk and how to manage the things. Now, volatility and wrong stock picks. Always we must be holding a very good quality with the doing a right research. The good quality companies should be taken into our portfolio, and the volatility and wrong with stock picks. And if you are not selecting a good company, and if you are going for some cyclical companies, there are some sectors which are slightly cyclical nature. If you end up taking cyclical stocks, then what happens is, there will be a lot of volatility. So naturally, that particular study has to be taken care. And of course, the asset mix, what it means is the diversification in terms of asset classes also. Not that you put all your money into stock market or investing, stock market investing. You should be like, diversify into different classes, asset classes, as I had mentioned earlier itself. Gold, real estate, some fixed income instruments, some debt funds, all these things. It should be spread across the different asset classes. And of course, we learn about that how much to invest in these asset classes in our further videos. But today's major agenda would be whether to invest or not is our understanding today. And the behavioral markets, follow a written plan and avoid leverage is a very, very important thing. Most of the things, you start investing and we try to take a leverage of, if the bank is giving us some funds to buy the thing, we'll try to use that, that leverage we try to use. Many of the banks use, in a format of MTF, all that. No, these things come with the associated risk available with that. One need to be very careful when taking these kind of leverages into action. And there is one thought process always it is spoken is, the conviction on particular stocks and the money invested should be your own. So never borrow the money and never borrow the conviction from others. So when you borrow the conviction, the downside is the even if the due to some natural factors, if it starts falling down by a small amount, also you will have a panic mode into running into mind. So what happens? You will in panic mode you will end up selling also. If you are very clear about fundamentals of the company and why company the small small volatility or the small fall in which is happening, the factors might be could be sometimes the natural factors, some small situations. Stock market is very sensitive to external happenings. Okay, external whatever the news we get, stock market is slightly more of the time sensitive to external things. So we need to know and identify whether there is any change in company, shift in the company's fundamentals, or it is because of the other external factors which is that particular move is happening. So the naturally the conviction part and the fund part also, the money what we are going to invest also should be from your own pocket. That is very, very important. And always keep 6 to 12 months of expenses outside the market, in the sense whatever the safety fund has to be kept in your hand. And time horizon it mentions in us that 10 plus years of, minimum of 3 to 5 years one must have the mind to go ahead with these kind of things. When you have a 3 to 5 years time horizon, invest in good companies with the definitely with the proper asset allocation, and the diversified portfolio can make a big difference as we see. Now how to start? Now that we have understood that certain factors positive and negatives, come to we and try to understand that, okay, if by investing in good companies there are definitely ways and roads to make a wealth, we understand, as we can as we have studied now. Or and definitely now how do we go and how do we start these things? So the step one is define goals and risk level. And there are definitely pointers which can make is what is our goal, why do you want to invest, or what is our end goal we want to define in that, and start with the small, start small, try to understand small but consistent, and naturally learn basics, only then pick direct stocks. A lot of exchange traded funds we say, ETFs we say, which are the index fund. One can start with those things also in initially. An exchange traded funds will have a compared to a lesser volatility, and though returns might be slightly lesser sometimes, but still there will be a less amount of volatility. One can start with those things definitely, and have a, direct stocks. We can have a understanding of good business understanding. Once you study those things, we can get onto the direct stocks also. That is one thing. Simple rules: diversify, no leverage, and long term review on monthly. All these quality stocks, maybe as we see today, there might be 1 or 2% up, next day it might be 2 or 3% down. So in when you hold a quality companies, let's assume any company for that matter, is there any change in fundamentals in next 2 days or 1 or 2 days? Actually, no. There won't be any. No, there won't be. Most of the time, there won't be, until unless there is a all intact management is same, and everything is same. There's nothing much which happens on day-to-day basis in terms of difference, except that they will be focusing on their work. And but the stock market is what happens. There will be some small volatility which is observed, 2% up down most of the days, and we must always keep in mind these things, that we always take care of long term perspective, and see the performance of these companies at least on monthly basis. Okay, and monthly and quarterly basis, we try to analyze these things, and not on daily basis for these core companies. We call this as the core companies also actually. Okay, so these are the pointers which we have understood now, that investing is good if with a good understanding of the stock market. So in during further sessions, we'll also try to understand the what should be our asset mix, how should we plan allocation on a different and diversified portfolio, how to create a portfolio, and all those things we'll learn in our further sessions. Uh, Thank you very much for joining. And before I would exit, I would inform all of you that there is two group links are given in the below this in the description box below this video. One is a Telegram group which will be giving you all the updates, and updates and alerts related to these things. Second will be a WhatsApp group where which will give you all the alerts only related to the our sessions which are going to come up during the further course of time. So thank you very much for joining, and please leave your comments in a comment box, which will support us in making further videos as we go ahead. Okay, so thank you.